It's very exciting. HFA is a great organization. It's here for hedge fund managers as well as service providers in the industry. And it's important because it's a good resource with so many changes that we've been seeing in our industry. So it's exciting to be here for the fourth Hedgeopolis as well as the 20th reunion for HFA. Yeah, I was speaking with somebody earlier today at the conference. I believe the industry is becoming a little bit more of a grassroots industry like it used to be. There's a lot of changes. There's a big trend towards passive investment management, and that's changing the outlook for the hedge fund strategy in general. There's also a lot of regulatory scrutiny on the space, and so there's a lot of opportunity to find ways to work together as a group to promote what it is that we do. Well, to start with, in the markets, it's going to be an exciting time. We'll see how this election season winds up, and then I think we can all expect a lot more market volatility going forward. For hedge fund managers, that means a lot of opportunity, investing, trading, getting new clients, making profits or taking losses, depending on where the strategies are. In my view, I think we're at the peak of a bubble in the fixed income market, and we shall see how that all works its way out going forward. For the hedge fund industry in particular, though, again, there's a lot of regulatory scrutiny, a lot of changes coming. We'll see, what happens with the presidential election in the United States, and I think the HFA stands to benefit from, observing those trends and lobbying around them and promoting our mission.
HFA organization.
Right, yeah. So we are a specialist in distressed securities investing. We invest long and short, up and down the capital structure of U.S. companies. We will short equities, we'll invest long in distressed debt, and then we'll invest long again after companies have restructured and reorganized in their post-reorganization equities. So 2016 has been a crazy year. There's been a lot of oil and gas bankruptcies. That's the main sector that lots of people are focused on right now for distressed activity. The other big sector that people aren't really talking about, but where there's a lot of activity, is metals and mining. Coal companies in particular. You've just seen a massive amount of bankruptcies there, a lot of workouts, and there have been some great opportunities investing in the distressed debt of those companies, seeing it through a bankruptcy or reorganization process, and then profiting on the other side after they've emerged from bankruptcy. I think that will continue into next year, probably shifting a little bit more away from coal and more towards oil and gas. When an industry goes through that much change and that much of a sudden external exogenous shock, you can expect a lot more consolidation. But the thing about oil and gas is that oil and gas E&P companies, drillers for oil and natural gas in the US, because of the new technology and because of super low interest rates, they were big recipients of new leveraged finance, high yield debt, junk debt. In fact, the E&P industry and the energy space in general accounted for about 20% of all high yield junk debt issuance for several years. So now companies, they may want to merge, but in many cases they have too much leverage to sort of make it through this cycle. Yeah, so there have been good opportunities to short companies that are facing the risk of bankruptcy. On the other hand, as companies go through a workout process, if you can find the fulcrum security, the highest debt level in that capital structure that's likely to get the new equity when a company reorganizes, that's the best opportunity in my view, provided it's cheap enough. It's an exciting time to be here at Hedgeopolis, and excited about being here for the fourth year and for the HFA as well.